You know the trucks. I mean, if you've ever driven on a highway in North America, you've seen them. Those iconic white and orange trucks are just everywhere. U-Haul is a brand that's pretty much woven into the fabric of American life. But, a brand you see all the time doesn't always equal a great investment. So, is it?
That's the big question, right? Just because a company is a household name doesn't mean its stock is a smart buy. So today, we're going to put on our investor hats and dig deep to answer that exact question. Is U-Haul, ticker UHAL-B, a stock you actually want to own for the long haul?
And, right out of the gate, we run into this really interesting puzzle. On one hand, you've got this steady, predictable revenue growth, which is exactly what you'd hope to see. But on the other side, there's a huge problem. The company is burning through cash, like a lot of cash. This conflict is really what we need to figure out.
All right, so to solve this puzzle, here's our game plan. First, we'll break down what the business actually does. Then, we'll look at its competitive advantages, its moat, and see if it has any leaks. After that, a full financial health check. Then, the fun part. We'll figure out U-Haul's true value, what price we should pay, and wrap it all up with a final verdict.
Okay, first things first. What is U-Haul really? Let's pop the hood and see how this thing actually runs.
So on the surface, the business model seems pretty simple, right? They rent out trucks and trailers, and they also have this huge network of self-storage facilities. But this has some really critical implications for investors. Because they have to own all those trucks and all that real estate, it's what we call an asset-intensive business. Its success is also tied to the housing market, which makes it cyclical. And all of that means the company is incredibly capital hungry. It just constantly needs a ton of cash to maintain everything and to grow.
So, with a business that needs so much cash, you'd hope it has a really strong competitive advantage, what investors call a moat, to protect it. So let's take a look. Does it?
U-Haul's moat really comes down to two big things. First, the brand is just dominant. When you think DIY moving, you think U-Haul. Second, and this is maybe even more important, is its incredible network. There's a U-Haul location almost everywhere you look. And in a business like this, convenience is everything. That density gives it a powerful local advantage that's just really hard for competitors like Penske or Budget to crack.
But here's the leak in the moat. For a company with such a strong brand and network, you'd expect it to be super profitable. A great moat should generate really high returns on the money it invests back into the business. But U-Haul's 5-year average return on invested capital is, well, it's under 6%. That's not great, and it tells us something's not quite clicking.
And this quote from the source analysis just hits the nail on the head. It says the moat is operational, not economic. So what does that mean? It means U-Haul is fantastic at protecting its market share. It keeps the competition away. But it doesn't automatically translate into high profits and great returns. So they're winning the market share game for sure, but they aren't necessarily winning the profitability game. Okay, so let's dig into those financials and see why those strong operations aren't leading to strong profits. It's time for a full health check. And wow, this chart just lays it all out there. Historically, U-Haul averaged about $665 million in net income. But in the last 12 months, that has just collapsed to $128 million. Now, this isn't some small dip. This is a massive drop in profitability.
And this slide right here, this is the headline risk. This is the big flashing red light. You see, free cash flow is the actual cash a business has left over after paying for everything. It's the lifeblood. And U-Haul isn't just low on cash flow. It's burning through it at an incredible rate, negative $1.6 billion in the last year alone. And that's because its spending on new trucks and facilities is just huge.
So you might be wondering, where is all this money for spending coming from? Well, it's coming from debt. And a really quick way to see this is to compare two numbers. Market cap is just the value of all the company's stock, but enterprise value includes the company's debt too. The fact that U-Haul's enterprise value is more than double its market cap is a huge signal that there's a ton of debt on the books, and that adds a whole other layer of risk for investors.
Okay, so what do we have? We have a company with a great brand, but really weak returns, collapsing profits, and it's burning cash. So, what is this business actually worth? Let's try to calculate its intrinsic value.
So what's intrinsic value? It's basically an estimate of a business's real underlying worth, totally separate from its day-to-day stock price. And because U-Haul's profits are so low right now, we can't just use today's numbers. We have to use something called normalized earnings, which is basically a more realistic guess of what the company could earn in a typical year once things get back to normal.
So based on the analysis, we can build out a few different scenarios. You can see here, in a pessimistic bear case, the stock might only be worth about 24 bucks. Our most likely base case, which is right there in the middle, assumes earnings get back to a more normal 500 million, and that gives us a value of $32.50. And even in an optimistic bull case, the value only gets up to $44 a share.
And here it is, the moment of truth. Our calculated base value for the stock is $32.50, but the market is currently pricing it at $46. That's a huge gap. This means the stock isn't just trading above our most likely value, it's trading above even our most optimistic scenario.
So if the current price is way too high, what is the right price to pay? Let's make this analysis really actionable for someone who wants to earn a solid return over the long run.
This table lays it all out, and it really depends on your personal investment goals. If you'd be happy with a 5% annual return, the analysis suggests you could probably pay up to 40 bucks. But if you're targeting a more solid 9% return per year, which is a great goal for long-term compounding, then you'd need to buy the stock at or below $30.
All right, we've looked under the hood, we've run the numbers, and we've calculated the value. Now it's time to bring it all together for the final verdict.
Based on all the evidence from our source, the conclusion is pretty crystal clear. At its current price of around $46, this is a stock to avoid. The risk just doesn't seem to be worth the potential reward. An attractive price to consider buying would be below $30. And if you already own it and the price happens to climb above $50, it would probably be a smart move to trim that position.
So here's the key takeaway, the whole point, really. Value investing is all about buying something for less than it's worth. That gives you a margin of safety. With U-Haul trading 42% above our calculated value, there is no margin of safety. In fact, it's the exact opposite. And that makes it a really high-risk proposition for a value investor today.
So that's our deep dive on U-Haul. But, the market is just full of fascinating companies. What's another business you've always been curious about? Let us know which stock you want us to break down next right down there in the comments.